Thank you very much, Chris. As I begin, let me thank the Rotary Club of West Nassau and President Craig Butler for allowing me this opportunity to present the perspectives of the central bank on the evolution of exchange control regime and to share the bank's ongoing plans for liberalization of the existing regime. Let me preface these remarks by saying that the Bahamas is not ready for any total or outright removal of exchange controls, even though we should strive for greater liberalization supported by the right kinds of reforms within our financial systems and the legal and institutional frameworks around which we do business, as well as national attitudes towards foreign ownership and foreign participation in the economy. Any sign of compromise in these areas would mean that we have to continue to adjust our views about the Bahamas, about where the Bahamas ought to end up in this process. I hope that this presentation will give you some insights on how our current regime supports a stable currency which remains fixed at 1-to-1 with the United States dollar. We are a very small, open economy with a fixed exchange rate, heavily dependent on foreign trade, and each of these factors has contributed to the foreign currency arrangements which we have in place. We have a GDP of still less than $10 billion. We have imports which make up more than 70% of what we consume, and an oil bill that is the largest slice of our expenditures. Tourism is by far the largest source of foreign exchange for the Bahamas. Now, the majority of our foreign trade has always been with the United States, and this has justified us keeping the two currencies aligned since 1972, and virtually almost fully aligned even in the decades before that. We maintain this relationship by using the foreign currency reserves as a buffer. By law, the reserves that the central bank holds can never fall below 50% of the value of the Bahamian dollar currency liabilities of the central bank. So that is a very important underlying principle in support of our currency. Now, the administration of the exchange control regime provides the central bank with the ability to manage net foreign currency flows through the economy and to fully accommodate all needs for trade, or what we term current account transactions, and to restrict flows to other areas to accommodate certain kinds of financial and investment-related transactions to what we term the capital account. The current regime, however, has become much more liberal over the years. Many Bahamians will only vaguely remember the practice of using the dollar cards, which was the first extent of liberalization from over-the-counter central bank approvals, and only for credit card payments at the time. The card lasted until 2006. In 1993, the trend of shifting certain approvals to commercial banks began, and this became more entrenched in further relaxation in 2006, 2010, and most recently in 2016. In 2006, the bank also introduced significant capital account relaxation, particularly for residents to participate in and to finance investments overseas. And this was expanded this year in 2016. Today, the capital account framework for the Bahamas includes the following: accommodation of regional cross-listings of securities both into and out of the Bahamas. This has been since 2006. And it is essentially an avenue for large public companies to raise capital throughout the Caribbean. There's also a funding arrangement for Bahamas dollar depository receipts, now for up to $35 million per annum for purchases of capital market investments outside the Bahamas. There's also cumulative access of up to $10 million per transaction per group every 3 years for direct investments that Bahamians may wish to make abroad. This facility is noteworthy because it allows individuals to acquire ownership in the international financial services sector and to invest in direct enterprise ownership in other countries. Work permit holders or non-residents also have access to domestic securities and to mortgage financing locally. And the National Insurance Board has access to up to $25 million a year for external portfolio investments. An investment currency market governs access to foreign currency for all other investment transactions. And the foreign currency that is sold through this market is currently offered at a reduced premium at 12.5% since 2006. I know that's still high by most estimates, but that compares to what used to be a premium of 25% on investment currency purchases. As a general comment, though, neither the Bahamas Depository Receipt or the BDR program or outward direct investments privileges have been used as extensively as the central bank expected. Even the investment currency market is arguably underutilized. That said, the area where the Bahamas sees most impact from the exchange control regime is for direct investments. Here, there are important caveats, however. The national investment policy of the Bahamas has the strongest influence on how direct investments are channeled in this economy. And aside from the administrative processes around this framework, these policies reflect the preference for investments in foreign exchange earning sectors. The policies also reflect sensitivities about foreign ownership of real property in the Bahamas and protectionist views about which sectors should be exclusively reserved for Bahamian ownership. So to discuss further liberalization of exchange control would require adjustment in these areas. It is in the area of investment flows where most of the interest in liberalization lies. At one end of the spectrum, this would include the longer-term support directly into businesses in the form of debt or equity, or on the other extreme, the short-term, more liquid transactions such as deposits, maturing debt, and capital market instruments. Now, in the extreme, a world without exchange control where there's significant prominence given to short-term transactions would have to be one in which we have to float the Bahamian dollar. It would have to be one in which the central bank, however, would still have to actively manage the stability of the currency. Alternatively, it could be a world in which the currency is abandoned altogether in favor of dollarization, and a strong emphasis then placed on supporting the behavior of financial institutions to prevent costly crises over indisciplined or excessively risky lending practice. Now, neither of these extreme scenarios would diminish the need for more active oversight in the area of financial stability or the accountability that would be necessary to national regulatory bodies. Indeed, dollarization would reduce the degrees of monetary policy independence that a country would have, and it would rest more of the pressures on generating fiscal policies that are credible for the longer term. A liberalized exchange control environment would be one in which investors vote with their capital, taking funds out of the Bahamas if confidence in economic, social, or political policies weaken, and rushing to bring monies in if confidence in these areas improves. What would this mean for the financial environment? Any large outflow of funds from the Bahamas would mean that the persons involved are selling the local currency to buy foreign currency. That is, they are converting deposits or they're selling businesses and personal assets such as stocks and other portfolio investments. Now, unless the central bank operates with a very large pool of foreign reserves, it would be expected that the only way to cope with such outflows would be to allow the currency to depreciate or to fall in value. Now, if confidence goes in the other direction, the policies and fundamentals improve. Because policies and fundamentals improve, then the extreme would be that the Bahamas would be faced with an influx of funds which would cause our currency to appreciate in value. Now, even if the population had unrestricted ability to move funds into and out of the Bahamas, the central bank would have an interest in keeping the exchange rate reasonably stable. If for no other reason, exchange rate stability matters for price stability. And price stability, or better yet, low inflation, matters for promoting social well-being and for providing businesses with a less turbulent environment for decision-making around long-term investments and employment. So what are the kinds of tools that one would need for effective management of the exchange rate? So if you do not have a large cushion of foreign reserves, a country or a central bank would lose the ability to intervene to keep the exchange rate stable. That's very important to understand. Now, one alternative is that the central bank, acting in the absence of the reserves, could raise interest rates to prevent monies from leaving the country. But you know that raising interest rates would hurt businesses that rely on credit to finance their activities. So if neither interest rates or other interventions exist, then the exchange rate would have to adjust to find a new equilibrium. Unfortunately, a lower value for the currency would, as I've hinted, translate into higher costs for imports and therefore to higher inflation. Now, the conventional view is that if a currency is worth less, the value of your exports become cheaper and therefore you get more demand outside for your exports. However, small countries like the Bahamas lack the ability to set or to vary the international price for their exports and would normally face a price that is already established or quoted in a major foreign currency such as the US dollar. If the export is tourism, then recognizing that most of the inputs to the industry are imported directly or indirectly would also mean that little or no reduction would be observed in the price of the tourism product from the perspective of the outside world. So in many countries, the large sudden outflow of capital is often also a large withdrawal of bank deposits. So banks can usually fail from such experiences if the deposits that the banks need to return are tied up in longer-term credit that will only be repaid gradually. So that is very important to understand. It is also worth noting that having an influx of capital could also be a challenge. Either the currency could be allowed to appreciate, or the central bank could receive the inflows and build up its foreign reserves. Now, if the monies have come into the country, they are ready for use. Care has to be taken to make sure that those funds are not misused. Because again, it could mean that the banks and the stock markets become exposed to potential collapse when investors take funds in the opposite direction in a sudden fashion. So, how does a country position itself to benefit from more liberal movement in capital while isolating itself from the downside risk of very liberal flows? That's something that we need to discuss. First, it requires that the economy and the policies evolve in a fashion that inspire longer-term confidence. That is, confidence of the nature that would not trigger sudden shifts in where monies are invested. Secondly, a country should also have the tools to manage the composition of the investment flows. So whether this is in terms of what business opportunities residents or non-residents are able to take advantage of, or whether this is about how the funds are composed in terms of whether they're highly liquid or long-term in nature. This is when capital or exchange controls start to take form. The capital flows that are more difficult to manage are those that are short-term in nature. They move quickly in and out. Examples would include deposits in banks, bank accounts, and investments in the stock markets, provided you can sell your stock market investments quickly. Now, one reaction you might have is that Bahamas should take a one-sided approach. So give Bahamian nationals the ability to invest abroad and keep the controls on inward flows. Now, that would mean that unless available foreign exchange that you have now is rationed, shortages would arise, and any hopes of maintaining a stable exchange rate would still be lost. So unrestricted outflows would only make sense if inflows are less restricted, because these would help fund outflows. The notion that these movements would net out, though, could be misplaced unless there were no unsettling investor speculation around economic policies and balances. So again, we would be left with having to tolerate some variability in the exchange rate. I would argue that an unfettered liberalization in the present environment would be undesirably disruptive. The economy needs to summon significant competitiveness challenges before being exposed in such a fashion. This will only happen gradually. Also, anticipating that the balance of short-term preference in the Bahamas is likely for outflows or net, we would need to accumulate a much larger stock of external reserves to keep the exchange rate within a stable zone. So this essentially requires movement along a path of growth that generates more net foreign exchange earnings, and a cultural shift in attitude towards more savings and less consumption. It also means a slower longer-term trend in consumer credit growth, so that more of the foreign exchange earnings, which we do earn, can be diverted into investments. It is also true that rationing foreign exchange is not an optimal solution for the long term. The incentive that the central banks would need to provide will therefore have to be in terms of our ability to alter the returns that investors expect from moving portfolio funds into and out of the local currency. So for example, this would include placing what we would term more potential constraints on commercial banks' ability to deploy the funds that they raise outside the Bahamas. Now, the central bank already has an array of tools that it can use in this regard, such as the ability to vary the reserve requirements on deposits that the commercial bank take in. The central bank can also vary or impose limits on the sort of exposures between local and foreign currency that banks can show on their balance sheets, the so-called mismatches. And the central bank, in its framework, has the ability to vary capital requirements for banks, which is a cost to a bank if the perceived riskiness of their operations has increased. So those are tools which a central bank can use to help manage the situation. Now, if we wanted to arrive to a point where the central bank could have even more capacity to manage short-term capital movements, reforms would also be needed to modernize the legal framework under which the central bank operates, to allow the central bank, for example, to issue its own debt securities, so that the central bank would then have the added scope, if necessary, to soak up excess liquidity within the markets. Now, certain current innovations are, once we complete some of the innovations we are currently undertaking for the government securities market, the bank's ability to engage in a lot more security-style operations to manage liquidity will be significantly enhanced. So that is a process in terms of getting to a better position. Now, having more dynamic and deeper capital markets is also a requirement for channels of intervention to be more effective. As it stands, our local capital markets are still very illiquid, and they require much greater volumes of securities and participants to be more liquid. Some of the 2006 liberalization initiatives which the central bank undertook were intended to further develop the local capital markets. We believe that these will require some tweaking in the years ahead to achieve more results in this area. That said, there is no medium-term path along which it is envisaged that exchange control liberalization would take us out as far as to put the exchange rate into play. Hence, there is still no justification for a path that would introduce the level of movement in short-term capital that comes to mind when Bahamians speak about liberalization in the present context. The central bank, however, does see further significant room for purposely targeted liberalization of capital flows and would be prepared to formulate recommendations to the government along these lines, in stages, however. At the same time, there's room for more aggressive liberalization of administrative policies, which the central bank can undertake, which recognizes that more delegated responsibilities can be given to commercial banks, and that this process can be backed by a greater focus within the central bank on compliance and monitoring of markets. Now, the subject of allowing Bahamians to borrow abroad, that's where a lot of the conversation is now focused today, allowing businesses to borrow abroad. And to touch on both direct and indirect ownership issues that on a case-by-case basis are still mostly reserved for decisions by the Minister of Finance, particularly when the source of the funding is not from a Bahamas-based commercial bank. So when it is a commercial bank, as the provider of the foreign currency funding, the central bank is already able to take the decisions directly and would normally limit its consideration on such cases to the foreign exchange earning potential of the borrower and whether the borrower would have been able to raise the funding in Bahamian dollars. Foreign exchange earning potential in today's terminology also means that the investment would also have the capacity to save on the need for imports of certain goods and services, and therefore foreign exchange savings potential if necessary. Any recommendation on liberalization on access to funding would therefore require greater authority within the central bank to approve certain financing against very transparent criteria under delegation from the Minister of Finance, and with the flexibility that would have this responsibility shared more with commercial banks under delegated authority. I would add that while long-term investments could benefit more readily from more liberalization, there is therefore nothing in our current framework of consideration, or I should say there is nothing in our current framework of consideration that would allow unfettered access of all sectors and all economic activities to foreign currency financing. There's also no consideration for easing access to foreign currency deposit account privileges, which would spark the kinds of exchange rate pressures that the Bahamas would wish to avoid at this juncture. So our liberalization proposals will consider how greater indigenous private access to external financing can be used to promote national development goals, and how such access can enhance our ability to earn or save foreign currency in the medium to longer term, as well as how they can help to fund activities that make the economy stronger in the longer term. So here are some of the areas that come to mind. Health sector and education, energy conservation, tourism, and linkages with the tourism sector, including commercial transportation, international financial services, development of primary sectors such as agriculture and fisheries, and other direct export activities. Now, moving more cautiously on portfolio activities, I should add, is consistent with the views and advice that the IMF and other international policy bodies would offer. That is, one should not proceed with portfolio or short-term flows any faster than the pace at which the financial sector and the central bank can mature to cope with them in a stable fashion. In fact, the IMF recognizes that for some countries, preconditions for full capital account liberalization, that is for short-term flows, may never be satisfied. Now, just to focus very close towards the end on some current initiative, in October of this year, the central bank began its public outreach on liberalization approaches. And this was initiated by a survey in which we had the participation of the Chamber of Commerce, as well as consultation with a number of industry groupings. The intention has been to gauge the current ease of access to business financing, as well as the appetite for greater access to such financing. The level of response to the survey, though, has been quite underwhelming, much fewer than 100. This is in a society where the cry is so constant about access to funding. Less than 100. As a matter of fact, I can say safely less than 50 so far complete responses. But still, the responses represent a broad spectrum of small, medium, and large businesses, including many in the wholesale and retail sectors. We are particularly keen, though, to receive more input from the small and medium-sized firms, as these are the ones that most often speak out about the consistent access to financing, given collateral requirements, the level of interest rates, and other factors. So more data gathering will likely be required, and we would invite more of the business communities to submit input. Nevertheless, we are obligated now to formulate recommendations to the government for reform that can begin to take hold as early as 2017. Our recommendation will consider the role that local banks play, as well as non-bank channels of potential access to financing. It should be pointed out, though, that, and this is very important, permission to access funding through alternative sources will not equate to success in finding funding in every case. That's very important. The inherent business plan risk will still dictate the attractiveness of proposals. Moreover, the expectation that funding will be at identical interest rates advertised abroad, that expectation should be tempered. The cost of funding and capital is inseparable from the risk of doing business within a country. A reasonable expectation, therefore, is that some premium on successful funding relative to the cost of US dollar capital should be expected for any business that may be the equivalent in every other respect to a business that they may try to compare themselves with that operates in the United States. So where does this leave us in terms of the way forward? The central bank will work diligently to ensure that we continue to make progress on recommended targeted easing of controls on capitals and make significant improvements in the administrative processes. We believe that a considerable amount of the concerns around exchange control still evolve around the administrative processes, so there is room for considerable gains even before we start to talk about liberalization that falls within the purview of a Minister of Finance. We will continue to build capacity to monitor foreign currency transactions and to manage the foreign reserves adequacy. Our strategic plan for exchange control administration will target progress in the following areas: investment in technology to automate more of the administrative processes, publication of detailed guidance notes to provide more transparency on exchange control administration, increased delegated responsibilities for commercial banks, backed by improved systems of monitoring, a review of the investment currency market, a further review of the BDR, or Bahamas Depository Receipt Regime, and more engaged discussions on the necessary reforms that would make the economy and the financial sector more resilient to capital flows. Constructive, informed dialogue on this topic is particularly in the context of goals that are being embraced for the National Development Plan will be critical for the Bahamas going forward. I therefore encourage you to provide input and to appreciate that it is a matter of national importance where often tailored interests will have to receive secondary consideration. Thank you very much.